Good morning, Kumar. Good morning, Sunil. Okay. So did you get a chance to go through that caselet? Good morning, Vinay. Good morning. Yeah. Or you want me to take you through the caselet, the third one? Yeah, match. Did you get a chance to go through the case number 3? This caselet. Yeah. Anyone who wants me to take you through the case, or otherwise we start with ratios? Or if you're struggling with any part in the case, just let me know. I'll explain that part. If you want me to take you through the entire case, I'll go through it. Okay, fine, Gaurav. I'll do it. Okay. Then again, let's just quickly do a recap. So in the last case, like I said, there's this lady who is a painter, and then you have this football player, and finally what they decide is that he'll sign the paintings and she'll sell the paintings, and that's how she starts making money. So the first cash, or the first item where we have money is getting involved, is this 95,000. So what she does with this 95,000 is that she uses this money and she starts her own business, her own venture. So this money is used as the seed capital to start the venture. So again, if I go to my solution, so this is the equity which is invested in the business, that is 95,000. So from the company's point of view, the cash will come in. So I'll say, okay, cash is an asset which is coming in. So I'll write it under the asset column, and I'll say 95,000 worth of cash has come in. At the same time, the company is liable to pay the money back to the shareholders. So under equity, you'll write 95,000. Any question on the first transaction, or the first item where money is getting involved, where the money is getting invested in the business? Okay. Then let's look at the first table. In the first table, they have given us the revenue that she's earning, the cost that she's incurring for the commission paid for travel, boarding and lodging, and the other miscellaneous expense. So again, if I go back to my Excel sheet, so if you look at the Excel, I've taken the total of the money that she's earning. So this is the total. And finally, what I've got is this amount, which is $63,50,000. So this is the total of the revenue that she's earning. Then the total of the travel, boarding and lodging cost. Again, I've added up all the numbers, which comes to 5,32,000. Then the total of the miscellaneous cost that she's incurring is 2,26,500. And then I've calculated the commission, because in the question, what they've done is they've given the commission percentage. So they're saying that, okay, you'll pay a commission of 5%. That will be paid on this 10 lakhs. Then 7.5% that will be paid on this 15 lakhs. So I've just calculated that amount over here in the last column. So I'm saying, okay, you're paying a commission of 5% on 10 lakhs. So how much is that? So that's 10 lakhs into 5%. I get a figure of 50,000. Similarly, I do it for the other percentages, and I calculate the total amount of commission which is to be paid. So any doubt with the total numbers, be it for the commission, miscellaneous expense, boarding and lodging, or the total revenue that she's earning, which is given in table number 1. Okay, fine. Then again, let's go down. So then what you have is the table number 2. So again, if I go to my question, the table number 2 gives me the details of the sports magazines, the month in which the contract was entered, and what was the value of the contract. And yesterday we discussed that the companies are saying that they'll make a payment after 4 months. So first, tell me, this total amount which is there, which is from the first line item, which is the contract value which was signed in the month of Jan, and till the last one, which is the contract value which is signed in the month of November, that's 94,000. Can I consider all of this as my income, or no, I shouldn't be considering this as my income because I won't be receiving the money? Or should I consider it as income? I will consider it as an income because in income statement, you do your accounting on an accrual basis. So again, yesterday we covered that concept of accrual. So there are two ways in which you do your accounting. One is accrual basis, one is cash basis. So I'll say, okay, all of this is my income. Some amount is yet to be received, some amount has been received. So whatever is yet to be received, I'll show that as a receivable, as a debtor. And balance, I'll say, okay, that amount has been collected and that goes to my cash balance. But the total amount, all of this is my revenue, this is my income. So again, if I go to my Excel, the total, I've totaled up all the numbers. That is the total revenue that she's generating from these magazines. And that comes to like $10,04,000. So that's my total revenue. Now, again, if I just scroll down, so what is my total revenue? My total revenue from the magazines is 10,04,000. That's this number. So 10,04,000, that's this number. Plus, along with that, she's also selling the paintings in auctions. So that is this number, which is 63,50,000. So I've got this number, 63,50,000. Yep. Any questions on this? Anyone with respect to the revenue, which is two sources. One is the auction revenue and the other one which she sells to the sports magazines. Okay, then let's move further. So the total revenue, if I sum it up, total revenue comes as 73,54,000. So that's the sum total of these two. Then if you move down, then what I've done is I've taken all my expenses. So again, if I look at my expenses were commission cost, traveling cost, travel, boarding, lodging cost, the miscellaneous expense, all of that. So again, if I look at this, this was 5,38,500, which is my commission cost. So again, if I go up, this is this 5,38,500, which is my commission cost. Miscellaneous expense was 2,26,500, and the traveling and the boarding cost was 5,32. So I've written these numbers over here. So I've got the traveling cost and the miscellaneous cost. Any doubt with these three numbers? The commission, traveling, boarding, and lodging cost, and the miscellaneous expense. Yeah, any questions on this? Fine. Okay, then let's move further. Then again, if I go back to the question says that she's also incurring a cost of 5% on material cost, labor cost, and it is 5% of the sales value. So first, let's look at what's my sale. My total sale is this amount, which is not only from the auction, but even the paintings which are given to the sports magazine. So that's my total revenue, which is 73,54,000. So I'll calculate 5% of this amount. So I've taken 5% of the total of these two numbers, and I get my material and labor cost as 3,67,700. So put together, this is my total expense. So my expense consists of commission, traveling, miscellaneous cost, material cost, labor cost. Along with that, I also have my court expense. So this amount, which is 16,64,700, is without considering the cost which is incurred for fighting the case, which amount of money that you pay to your lawyers. So that's not captured over here, that I'm capturing separately. But any questions till here? 16,64,700. Then let's move to the court expense. If you look at the court expense, then there are two cases which are being fought. One is against the company and one is for the breach of engagement. The one which is against the company is an expense for the company. So I'll take this $1.7 million as an expense for the company. So I'll treat that as my legal expense. expense. So I'd say my court expense is this 17 lakhs, which is the cost which is being incurred for fighting the case which has been filed against the company. And what do I do with this 1 million? I'll say that, okay, I've paid 1 million. So money is going out, cash is going out. So cash will go down. But at the same time, I'll say that, okay, I have to recover it from that promoter, the lady, which is Cantonella. So I'll say, okay, cash balance for the company is going down, but you will recover it from the promoter. So it will not be treated as an expense because that's got nothing to do with the day-to-day affairs of the company. The case was filed against the promoter for breach of engagement. So that's not a company's official expense. So finally, if I look at my profit or loss should come as the total income minus the total expense, which is 39,89,300. Okay. Now, if I go back to my accounting equation, so the first one we've already captured, which is the money which is getting invested in terms of share capital. Then let's look at the revenues. So the first revenue was the revenue that you generate from the auction. And then you also generate revenue by selling the paintings to the sports magazines. So if I look at the first one, which is the auction revenue. So total of the auction revenue was 63,50,000. So I'll take this 63,50,000, and nothing is mentioned whether there is any delay in payment or not. So we'll simply assume that the money is paid immediately. So I'll take 63,50,000 as my income, as my revenue. And at the same time, I'll simply assume that the money is received from the auction. So the cash balance will go up. So I'll show it on the asset side, and my income or revenue is going up. So I'll show it under the revenue column. So any doubt with the auction revenue? Now for the magazine revenue, what is the total revenue that you generate? The total revenue that you're generating is this 10,04,000. So this is pretty straightforward, 10,04,000. So that's not an issue. So you take this 10,04,000 and you show it as an income. So this is fine. This is 10,04,000. But then what is happening with this 10,04,000? Some amount is received in cash and some amount is yet to be recovered. So I'll just write as debtors or receivables, whatever you want to write. Now, what is received in cash? They're saying payment would be made after 4 months. So if I look at this table number 2, have I received the revenue for the month of November? Because I'm doing my calculations as of 31st December. So have I received this money of 94,000? No, because the payment would be done after 4 months. Tell me, have I received this revenue of September, 80,000? Again, a big no, because this will be received again after 4 months, which means it will not be collected till 31st of December. What about this sale which is happening in the month of August? Have I received this amount? Or no, this is also not yet received. This is received. Something that you sell in the month of August, you will get your money after 4 months. So for simplicity, let's say you're selling something on 10th of August. So 10th of September is 1 month, then 10th of October is the second month, then 10th of November, and then 10th of December. So you'll get the money in the month of December. So whatever you're selling in the month of August, you will get the money in the month of December. So again, I will take that as an inflow. I will not just take it as a part of recoverable amount. So all the amounts till the month of August, that is till 85,000. So starting with 1,50,000 till 85,000, all this has been received. Amount yet to be received is just the last two, which is 80,000 and 94,000. So any doubt with what has been received and what is yet to be received? Yep. Any questions on that? The amount received and the amount yet to be received. Okay, fine. So again, if I go to my Excel, I'm saying, okay, out of this 10,04,000, some amount has been received, some amount is yet to be received. So if I add up all the numbers for cash, that will come as 8,30,000. And then if I add the last two numbers, then the last two numbers put together will come to 1,74,000. So this is what I've done over here. First, I'm saying that, okay, whatever amount I've sold, it's an income for me, and I'm assuming that nothing is being received. Then I'll say, okay, out of this 10,04,000, some amount is received, which is 8,30,000, and this balance 8,30,000 out of this receivable, has been received. So this 1,74,000 is still outstanding, and 8,30,000 has been received. So that's the breakup. So if you want to do a net figure, what you can do is you can just write off these two, and you can just write receivables over here as 1,74,000. So this 1,74,000 is a net of these two numbers, which is 10,04,000 and 8,30,000. Any questions on this? Otherwise, you show the proper breakup 10,04,000 and then minus 8,30,000, or you just show the net number saying that, okay, 1,74,000 is yet to be received from the magazine guys. Any questions on this? Anyone? Okay, fine. So then let's look at the expenses incurred. So again, if I go back to the calculation that we've already done in the earlier sheet, what are my total expenses? My total expenses, excluding the court expenses, were 16,64,700. Why we add all the receivables? Like, again, what I'm assuming is that when I sell the paintings, I don't get the money immediately. I get it after 4 months. So what I've done is I've split it into two parts. I'm saying that, okay, I've generated a revenue of 10,04,000, and this is the amount which is yet to be recovered. But out of this, I've received 8,30,000, which means balance is yet to be received. So 8,30,000 is the cash that I've got. And then I'm saying out of 10,04,000, if 830 has been received, I should deduct it from the receivable and I should get a net figure. So like I said, if this is confusing, just remove these two and just write it once, write receivable as 1,74,000. So that's absolutely fine. No issues with that. Yep. Mansi, any other question? Okay, fine. So what are my expenses? My expenses over here are the commission cost, traveling cost, miscellaneous cost, the material and the labor cost, which put together is 16,64,700. So I'll take that, and nothing is mentioned. So I'll assume that the amount has been paid. So cash will go out. So I'll write it under the asset column saying that cash balance is going down. And on the expense column, I'll show it as an expense, which is 16,64,700. Along with this, the company is incurring the court expense case. So that is 17 lakhs. So I'll take this 17 lakhs. So I'll take the court expense case, which is 17 lakhs. So of course, money will go out. So that's cash. I'll show it under the asset column saying that, okay, 17 lakhs has been spent. And it's an official expense for the company. That's a legal cost. So I'll show it under the expense column. But the remaining 10,000 cost, or sorry, the 10 lakh cost, which is incurred in the court where the lawyers are fighting for the breach of engagement, that's got nothing to do with the company. So of course, the company has spent the money. So cash is going out. So I'll write it under the asset column saying that, okay, cash balance has gone down. But at the same time, I'll say that, okay, I have to recover this money from the promoter. So you can write either other recoverables, or maybe you can just write the name of the promoter. You can write Cantonella and write 10 lakhs so that you clearly know that, okay, this amount is recoverable from the promoter. Her name is Cantonella. So any questions on the accounting equation? Once this is ready, then you just have to make your income statement and your balance sheet. So once we have the numbers in front of us, then what I'll do is we'll just go to the respective columns. So I'll take all my expenses. So my total of the expense is this one. That's the expense incurred and the court expense. That's 33,64,700. So I'll take that over here, 33,64,700. The total of the revenue is 73,54,000. So I'll take the revenue and I'll get a profit, which is 39,89,300. This profit again will get transferred to the balance sheet in terms of reserves and surplus. So I'll transfer it over here. So that's my profit, which is getting added over here. So that's 39,89,300. Then I have the equity share capital, which is 95,000. So I'll take it over here. So that's my equity share capital, which is 95,000. And then there's no liability as such. Then I move to my asset side. So when I look at my assets, I've got different types of assets. So I'll total them up and accordingly I'll write it and get my balance sheet. So I've got different types of assets. The first asset that I have is cash. So I've got cash. Then I've got receivables and I've got other receivables. So either you can club it together or you can show it separately. So if I look at my asset side, I've got the cash. So I'll take all my cash transactions, sum it up, and I'll get the total cash balance, which should be appearing in the balance sheet. Then I've written receivables from the promoter, that's Cantonella, which is worth 10 lakhs. That's this amount. And then the debtor, which is, or the money which is yet to be received from the sports magazines, which is 1,74,000. So I've got two debtors. One is the sports magazine, another one is the promoter. So either you club it together or you show it separately, magazine and the promoter separately. It's your call. And finally, if you look at it, the total of the balance sheet will also tally, because if you've done it correctly, then the balance sheet has to tally. So any doubt with this, anyone, any part? Yeah, any questions on this? The third case. Okay. So fine. Then let's move to today's session. Okay. So in today's session, what we're going to do is we'll look at ratio analysis, which is a tool which gives you a better understanding of what's happening in the company. Okay, got a chat. Can we get more such examples to practice? So I'll try and see if I can get it up. So because this, when it was made, it took some amount of time. I'll just see if I can, if it's readily available, I'll forward it to you along with the solutions. If the question is available, I'll at least forward you the question so that you can go through those questions. So I'll see if I can get it. I'll definitely forward it. Yeah. So in today's session, like I said, we'll look at ratio analysis. And if you look at ratios, there are basically 4 different categories of ratios. So in today's session, we look at 3, which is liquidity, we look at profitability, we look at solvency, and there is one more set of ratios. Can anyone tell me which is the 4th set of ratio? You've got liquidity ratios, profitability ratios, solvency ratios, and then you've got one more. So there's one more ratio which we'll be covering in the 4th session. Okay, that's basically your ratios. Some people also call it as efficiency ratios. So different names given, but it's the same set of ratios. So turnover ratios, efficiency ratios. So in today's session, we look at the first 3, which is liquidity, profitability, and solvency. Okay, and if you look at liquidity, there are various liquidity ratios. So we look at these 6, 7 ratios under liquidity. Then we have these 4, 5 ratios under profitability. So we look at these profitability ratios. And then under solvency, we've got these 3, 4 ratios, which will look at solvency. So first, let's try and cover up the basics. So first, let's understand what is a ratio. Anyone, what's a ratio? It's a very simple question done at the school level, ratio and proportion. What's a ratio? What's a ratio, anyone? Ratio is a percentage. Okay, fine. You can calculate that in a percentage. Typically, it's a proportion. So ratio is nothing but one number divided by another number. So I'll take one number in the numerator, divided by another number, and finally what I get is a ratio. So let's say if I'm looking at this subject, which is financial accounting for managers, so that's FAM, and I tell you that there is one candidate who's got 88 out of 100. So all your internals, end term put together, this person has got 88. Can you tell me, or what is it that you can infer and tell me about this candidate? This candidate has got 88 marks in financial accounting for managers. So what is it that you can infer and tell me? He's got 88 out of 100, so that's like what, 88%. Fine, okay, so that's 88%, but then there's no value addition. Anything else that you can tell me if I just tell you that he's got 88? What an answer. He's a genius. How do you know he's a genius? Okay, 12% chance of improvement. Again, I cannot say whether he's a genius or whether he is an extraordinary student or he's a good student unless and until I tell you what's the class average. So let's say if I tell you the class average itself is 97. Now what's your opinion? Is he still a genius? And this is the class average, 97. Or your view about the candidate changes now. He's an average candidate. So a ratio on a standalone basis will not help you too much unless and until you compare it with something else. So when you're looking at a company and you calculate ratios, so you calculate all the ratios on a standalone basis, it becomes difficult for you to try and infer or interpret something. So you need a comparable. So either what you do is you look at the past track record. So you look at the trend. So let's say you calculate a ratio. Let's say hypothetically, I'm calculating a current ratio. So I calculate the current ratio. The current ratio, let's say, comes as 1.8. Now it becomes difficult for me to say what is 1.8. Is it good? Is it bad? What is happening in the company? So either I look within the company and I see, okay, what has happened to this ratio over the last 3, 4, 5 years? So what is the trend? Is it going up? Is it fluctuating? Is it going down? So is there some sort of a trend which is happening? So I typically need a comparable so that I can understand what's happening with the ratio. So either I look within the company or I start comparing myself with the peers. So I look at what's happening in the industry. So I look at, okay, other players in the same sector, what is their current ratio? And then I can come to some sort of a conclusion whether I'm at par, I'm below average, above average. I get some sort of an idea. Second important thing, when you're looking at a ratio, I gave you the marks for the subject, which is, let's say, 88. Let's say you have another subject which is on analytics. And the same guy has got, let's say, 92 in analytics. So I just give you two numbers. He's got 88 in FAM and 92 in analytics. Now, can you tell me something about this candidate? He's got 88 in FAM, 92 in analytics. Better in analytics, more interested in analytics, analytical skills are better. Again, if I tell you now that the class average in analytics is 100%. So again, when you are comparing one thing, which is the marks that this person has got in FAM, that has to be compared with the marks that other candidates have got in FAM. You can't compare FAM with, let's say, analytics. Maybe analytics is a very tough paper, or maybe it's a very easy paper, or maybe the checking over there was difficult. Maybe the question paper was of a different quality. I can't compare them. Apples have to be compared with apples. You can't compare apples with oranges. So similarly, I can't look at a current ratio of, let's say, Tata Steel and compare it with, let's say, the debt equity ratio of Infosys. Well, let's say the debt equity ratio for Infosys is 0. I can't compare 1.8 of Tata Steel with debt equity of Infosys, or maybe a debt equity of even Tata Steel itself. So maybe the debt equity for Tata Steel could be, let's say, 2:1. So I can't compare these two numbers because the base is not the same. One is a current ratio, that is a different set of ratio. Another one is a different set of ratio, which is a debt equity ratio. So the base has to be the same. You have to compare things which have a common base. So these are the two most important things in ratios. So on a standalone basis, ratios will not help you. You need a comparable. So either you start looking within the company or you compare yourself with your peers. At the same time, when you're doing a comparison, compare apples with apples. Don't start comparing apples with oranges. Otherwise, you'll not come to a proper conclusion. Now, let's say I want to calculate, let's say maybe a few ratios for your batch. So as a professor, I want to calculate a few ratios for your batch. What ratios should I calculate, which would be relevant for me? Okay. What ratios can I calculate for your batch so that they help me in some sort of a proper analysis and interpretation about your batch? Passing percentage. Okay, fine. So maybe it could be one rate. So I could look at what's the passing percentage. Fine. I mean, I would not be that interested, but okay, I'll still consider it. Experience. Fine. That's good. So I'll basically be looking at people who've got experience of, let's say, I mean, I'll split that into different categories. I'll say, okay, people with experience of up to 3 years. I mean, they are like more or less like freshers because they have got little experience. Then people who got experience of more than 3 years to, let's say, up to 7 or 8 years. So they've got some amount of experience. And then people who've got experience of more than 8 or 10 years. So they've been into the industry for, let's say, a longer time. So accordingly, once you get some sort of an idea as to what the batch consists of, you can accordingly fine tune the way you're teaching. So let's say if the entire batch or 99% of the students in the batch are freshers, then accordingly the way the course is to be delivered would be different compared to, let's say, if everyone in the batch has an experience of 20-25 years where you're teaching people at the top management or the middle management, the approach and the way of teaching would be entirely different. Then technical background, I would look at your academic background, technical background, whether you're from commerce, non-commerce, so on and so forth. Again, that would help me in fine-tuning the way I teach, because again, if you're from the non-commerce background, then the basics have to be covered in depth. If you're from the commerce background, briefly cover the basics and then directly take the speed. So basically, these would be a few important ratios. So when you pick up any book on finance, you will get like 100, 150 ratios. Doesn't make sense. I mean, let the authors publish these many ratios. It's okay for them to sell their books. Typically in real life, you need like 15 to 20 ratios to go through. And if you go through these 15, 20 ratios, you get a fair idea as to what's happening in the company. So there are like 15, 20 ratios which are important. You need to just go through and calculate these ratios, look at what's happening within the company, what's happening with your peers, and you get a fair idea as to how the company is placed, rather than going through these 100, 150 ratios. So ratio is basically a tool which is helpful in doing some sort of an analysis. And basically, if you look at ratios, ratios help you in doing three things. One is inter-firm comparison, one is intra-firm comparison, and the other one is industry analysis. So ratios help you in doing three things. One is inter-firm analysis, another is intra-firm analysis, and the next one is industry analysis. So they basically help in three things: inter-firm, intra-firm, and industry analysis. Let's look at each one of them. Let's look at inter-firm. Can you tell me what do you mean by inter-firm analysis? What's inter-firm analysis? Anything, any vague idea? What do you think would be an inter-firm analysis? Like Tata with Mahindra, fine. So I start comparing two different companies in the same sector. So I look at, let's say, Infosys with TCS, with Wipro, with Tech Mahindra, so on and so forth. That's inter-firm. Yunus, what you're saying is within the department, that will be intra-firm. Intra-firm is within. Inter-firm is when you look at yourself and you compare it with your peers. Okay. So inter-firm is when you start comparing yourself with your peers. So let's look at the first one, how ratios could help us in doing an inter-firm analysis. Let's say you are working with a mutual fund and as a mutual fund manager, and you are tracking the cement sector. You are bullish about the country. You feel that the country would do really well. The GDP of the economy or the country would grow. For the GDP to grow, what you typically need is infrastructure. For infrastructure, what you typically need is cement. So if you are bullish that the economy would do well, GDP would grow, infrastructure has to go up. And for infrastructure to go up, cement is required. and you are tracking the cement sector. So basically what you'll do is you'll start with the listed cement companies. So let's say you get 15 companies. So once you get a list of 15 cement companies which are listed on the stock exchange, then what you try and do is you look at all these companies and you try and find out which of these companies are good in terms of, let's say, economies of scale, maybe in terms of technology, maybe in terms of the assets that they're using. Is it a foreign asset that you've acquired from maybe Germany or US, or is it the asset that you have which is made by an Indian company? Because again, depending upon the quality, the efficiency could change. Then you could look at, let's say, what's the input output ratio. And looking at all these 5-6 parameters, you try to filter it down and you say that, okay, these are the companies which have got an upper hand out of these 15 companies. So out of 15 companies, you'll filter it down and come down to, let's say, 4 to 5 companies, depending upon which companies have economies to scale, better access to technology, better assets, the input output ratio is better, less wastage, so on and so forth. Once you come down to these 4-5 companies, that is when you start doing a ratio analysis. So you'll say, okay, I've got these 4-5 companies, and now I have to choose 2 companies out of these 5 companies. So let's do a ratio analysis, calculate the ratios for these 4-5 companies. So maybe I'll calculate a ratio for Ambuja with respect to, let's say, Ultratech and so on and so forth. So I look at all these cement companies, I calculate the ratios, and then I'll figure out which are the 2 best cement companies. So that's your inter-firm analysis. You compare one company with the other company. Any questions on this before we look at intra-firm? Okay, and let's look at intra-firm. Intra-firm is when you start looking within the company. Again, let's try and understand this with the help of an example. Let's say you're a power generation company. Maybe let's say you're a company like, let's say, NTPC. Okay, so if you look at NTPC, NTPC is a government entity, and they have thermal power plants, which means what they need is typically coal to generate electricity. Now, if I'm looking at, let's say, maybe one of the power plants, which is located in, let's say, Khaparkeda, which is near Nagpur, and it's a pithead power plant, which means it's close to the source of raw material. So when they need coal, they'll place an order within a few hours or maybe within a day or so, they'll get the raw material. Now, you're looking at a few numbers for this power plant, and you realize that the raw material to sales ratio last year was 17%, but this year has gone up to 22%. So you're looking at raw material to sales ratio. So you're just looking at, let's say, specifically one ratio. You're looking within the company, and this one ratio catches your attention because raw material to sales ratio last year was 17%. This year it has gone up to 22%. Can you tell me what's happening within the company? So I'm looking at this ratio, raw material to sales ratio. What do you think is happening within the company? From 17%, it went to 22%. Cost of raw material has gone up. Great. Okay. So one option is that the cost has gone up. What else? Raw material source has changed. Again, cost has gone up. Fine. What else? Efficiency has gone down, which means I'm just writing quantity has gone up. So I'm saying, okay, efficiency has gone down, which means the quantity that you're consuming has gone up. Okay. What else would have happened? So the cost of raw material could have gone up, efficiency has gone down, which means you're consuming more raw material. So that could be the case. Sales could have gone down. Great. So again, if my ratio is going up, that is, it moves from 17% to 22%. Why would it go up? Either because the numerator is going up or the denominator is going down. Again, like you said, wastage. So if my denominator is going down, which means my sales are going down. Now again, when your sales are going down, you'll have to see, is it that the sales quantity is going down, or is it that the quantity is the same, but because of competition, your selling price has gone down? So initially, let's say you were selling X units of electricity and each unit was being sold for 5 rupees. But because of a lot of competition, or maybe because of less demand, what you've done is you're not selling it for 5 rupees, you're selling it for 4.9 rupees now. So quantity is the same, but the selling price has gone down. Or it could be that the selling price is the same, but the quantity has gone down. Or it could be a combination of the two, because of which your sales have gone down. So your sales could get impacted either because of the quantity, or because of the change in the selling price, or it's a combination of both. Similarly, when I'm looking at the numerator could be either that the cost of raw material has gone up. So I was procuring coal from, let's say, Coal India, and Coal India was charging me X rupees per ton of coal. Now they're charging me X plus 10% per ton of coal. So the cost has gone up for inflation or whatever. So again, cost has gone up, because of which my raw material cost has gone up, and therefore the ratio goes up. Or vice versa, I'm inefficient, there is wastage, because of which I'm consuming more coal. So till last year, to make 1 unit of electricity, let's say I was consuming 2 kgs of coal, but now I'm consuming 2.2 kgs of coal. So this again gives me an indication why this is happening. It could be because of wastage, maybe theft, because my assets are depleted, they're old, so I'm using more quantity, or maybe the raw material, the quality itself has gone down. Because typically, if you look at, let's say, Indian coal has a lot of ash content compared to, let's say, the coal that you get from Indonesia and Australia. So the ash content is low. So the calorific value of the Indian coal approximately goes down. Because you have too much of ash content, the calorific value goes down, and therefore you have to consume more coal to generate the same amount of electricity compared to, let's say, had you used an imported coal. So let's say if I'm looking at maybe the Reliance or the Adani group, and they get coal from, let's say, Australia or Indonesia, they could be using less coal compared to, let's say, NTPC, which is predominantly dependent upon the coal which they get from Coal India, which is an Indian company. And this coal has a lot of ash content. So there could be various reasons. So ratios will raise red flags. And then you'll have to deep dive and figure out what is the reason why this ratio has changed. Is it because I'm losing out on the market? Is it that there's a lot of competition that has come in, because of which my selling price has gone down? Is it that I've changed my supplier, the cost has gone up, inflation has gone up? Or there is some problem with the quantity, the quality of the raw material, there is wastage, there is inefficiency, all of this. And once you get to know what is the real reason, accordingly, you should be taking corrective measures. Any doubt with intra-firm analysis before you look at industry analysis? Okay, then let's look at the third one. The third one, ratios help us in doing industry analysis. Let's say Mr. Gautam Adani comes and says, I want to invest 5 lakh crore in a sector where my fixed asset turnover ratio is low. And I'll tell you how you calculate your fixed asset turnover ratio. Fixed asset turnover ratio is nothing but sales upon fixed asset. So he's saying that, okay, he wants to invest 5 lakh crore in a sector where the fixed asset turnover ratio is low. How you calculate fixed asset turnover? It's sales upon fixed asset. Is he focusing on service sector, or is he focusing on capital intensive sectors? On the basis of this data. So let's say you're working with McKinsey, you're a consultant, he gives you a call. I want to invest 5 lakh crores in a sector where fixed asset turnover ratio is low. Suggest me the sectors where I should be investing. Is he trying to give you a hint that he wants to invest in service sector or capital intensive sectors, and why? Yeah, anyone from the batch? Where is he trying to invest? Service sector or capital intensive sectors? The asset turnover ratio is low. That's sales upon assets. Capital intensive, great. He's trying to invest in capital intensive because the asset turnover ratio is low, which means the denominator is far bigger compared to the numerator. So in a capital intensive sector, typically infrastructure companies, You will have a lot of fixed assets, non-current assets compared to the sales that you'll be generating. So your asset turnover ratio would be low. So he's trying to give you an idea about which sector, which industry he wants to invest. It's service, not capital intensive. So this is how ratios typically help us in doing a proper analysis. Then let's look at the various categories of ratios. You basically have 4 categories of ratios. One is your liquidity ratio. Then what you have is your leverage ratios. Then maybe you can have your turnover ratios or efficiency ratios. And then what you'll have is your profitability ratios. So turnover ratios are also known as efficiency ratios, also known as activity ratios. So you have liquidity ratios, leverage ratios. These basically deal with your long-term solvency. And liquidity deals with your short-term solvency. So you have 4 categories of ratios: liquidity, leverage, turnover, and profitability and valuation ratios. Anyone who can tell me what do you mean by liquidity ratios? What do these ratios tell you basically? You've calculated a few liquidity ratios. What do they basically tell you? Cash reserve. Okay, fine. Liquidity ratio basically focuses and lets you know whether you will be able to fulfill your short-term commitments on time or not. So let's say there is a creditor who's standing and telling you, okay, make a payment in the next 15 days. Do you have enough liquidity to make the payment in the next 15 days, 1 month, 3 months? So you're looking at short-term repayment capacity as far as liquidity ratio is concerned. But when I look at leverage ratio, this is the reverse. In leverage ratios, I'm looking at my long-term repayment capacity. If I've taken debt from the bank, which is a 5-year, a 10-year, or a 15-year debt, will I be in a position to repay off the loan or not? So it talks about long-term repayment capacity. It talks about how the company has been funded. It talks about basically the capital structure of the company. Do you have equity? Do you have debt? Do you have preference shares? All of that. So that's your leverage ratio. Long-term repayment capacity and how the company has been funded. It talks about the capital structure. Then let's look at turnover or efficiency or activity ratio. Anyone who can tell me what do you mean by turnover or efficiency or activity ratios? Utilization of resources. Great. So as the name suggests, efficiency, it talks how efficiently the company is being run, it is being managed. For example, let's say if I look at the HR department. Now, one of the measures on which an HR department could be, let's say, I want to look at the efficiency of the HR department, I could start looking at the attrition rates. So I look at the attrition rate and then accordingly, I'll have a word with the HR department. Why is it that the attrition rate in my company is too high compared to the other companies in the same sector? Is it that we don't have good policies as far as employees are concerned? We are not paying them enough. We are not friendly enough. So there is some problem within the company because of which the attrition is too high. So they'll have to figure it out. So again, like I said, ratios will raise red flags and then accordingly you need to take the corrective measures. And finally, what you have is the profitability and the valuation ratios. These ratios basically tell you how profitable the entity is, maybe from the point of view of a shareholder, maybe from the point of view of everyone who's funded the company. And we could be looking at various ratios over here. So there are basically 4 categories: liquidity, leverage, turnover, or you call it as efficiency or activity, and profitability ratios. Any doubt with the 4 broad categories? So today we'll be covering liquidity, we'll cover leverage, and we'll cover profitability. This we'll cover in the 4th session. Any questions still here before we start looking at the first one, which is liquidity ratio? Okay, and let's look at the first ratio, which is liquidity ratio. In liquidity ratios, we'll be looking at all these ratios. So let's look at the first one, which is a current ratio. How do you calculate current ratio? Current ratio is nothing but current assets divided by current liabilities. So you take all your current assets divided by the current liabilities, you'll get a number. That number is known as a current ratio. Let's put some numbers to it. So let's say my total of the current asset is 5 crores, current liability is 2 crores. I'll divide 5 by 2, I'll get a current ratio of 2.5. So that's my current ratio. What does it tell me when I get a current ratio of 2.5? It tells me that for every 1 rupee of current liability that I have 2.5 rupees of current assets with me. So it talks about the liquidity position. Will you be in a position to pay off your short-term liabilities or current liabilities on time, or you could be struggling? Do you have some liquidity issues? Let's take an example. Let's say I'm in the process of setting up a 3 million ton steel plant. Okay, so let's look at option 1. Let's say this is my balance sheet. I've got non-current assets, I've got current assets, I've got current liabilities, and I've got long-term sources, which will include my share capital, reserves and surplus, and my long-term debt, bonds, debentures, whatever. So I've got short-term sources and long-term sources. I've got non-current assets and current assets. Let's say I've got in touch with the consultant. The consultant has told me that you need 1200 crores of non-current assets, 800 crores of current assets. Now, there are different ways in which the company could be funded. So let's say the first one is where I go for a back-to-back financing, where I say that, okay, non-current assets will be funded through your long-term sources. Current assets will be funded through your short-term sources. So that's one way of funding the transaction. Another way could be I'll have the same assets and assets. So this will still be 1200. This will be 800. But I just change the proportion. Now I'll say, okay, let's say my long-term sources are 1400. And let's say this is 600. So that's the second option. And let's say I've got a third option. Third option, this is again 1200 and 800. But now I change the numbers. Let's say this becomes 1000. And this is also 1000. So if you have these three options in front of you, that's option 1, 2, and 3. From a liquidity point of view, which option do you think is better? Option 1, option 2, or option 3? So I'm looking at liquidity. Which option do you think is better? Option 1, option 2, option 3, and why? Option 1, okay. I've got an answer saying that option 1 is better. Okay. Any other views on this? Okay. 2, Mansi is saying it's 2. Okay, let's calculate the current ratio. If I calculate the current ratio, what is my current ratio? Current asset upon current liability. In this case, it will be 800 upon 800, which is 1. If I calculate the current ratio over here, current ratio over here will be 800 upon 600. That's 4 by 3. That makes it 1.33. And if I calculate the current ratio over here, current ratio over here is 0.8. Now, generally, companies would like to have a current ratio which is more than 1. Which means if I have a current liability of 1, then I have current assets which are more than 1, and I can use that to pay off my current liabilities on time. I will not struggle. I will not have a liquidity issue. So generally, the second option would be preferred. But a lot of companies globally, not only in India, but internationally, also operate at this level, where the current ratio is less than 1. And they're extremely profitable. They're doing well. They're big brands. So look at companies maybe like, let's say, HUL or any other FMCG company, Dabur. You'll find a lot of these FMCG companies, they have a current ratio which is less than 1. And they're profitable. They're not doing well. It's not that they're a loss-making entity. They're struggling. They're defaulting. They're not making the payment to the suppliers on time. No. So again, you would look at these two options and then figure out which one is a better one. So like I said, companies generally prefer this because they want to be a little safe. if I have a current liability of 1, I should have current assets of more than 1, so that if somebody is standing at the door, I can easily make my payment and fulfill my short-term obligations, and I don't end up defaulting. Now, how did this ratio of 1.33 basically come into existence? Now, this came into existence because of the Tandon Committee. So there was a committee which was set up around 40 years back, Tandon Committee. And this committee said there are basically 3 norms. That's norm 1, norm 2, norm 3. Norm 2 became the most famous, which said that your current ratio should be 1.33. And most of the banks started following this norm, and they said that, okay, companies should have a current ratio of 1.33. If you have a current ratio of 1.33, there is a liquidity issue. And if you're coming for a short-term loan or a financing, we will not sanction the loan, we will not give you the loan. But then there was a big uproar in the 90s, and a lot of industrialists approached the finance minister and they said, how can you have a cutoff and say that 1.33 is a current ratio which is across sectors, across companies? You can't have a standard like this. Because, for example, let's say I go back to the same example of power generation companies. NTPC is a pithead power plant company, which means they're sitting close to the source of raw material, and they would have raw material stock which is extremely low, because they'll place the order, they'll get the coal within a few hours or maybe within 1 or 2 days. So I will keep a coal stock of maybe a week or a 10 days. But at the same time, if I am, let's say, Reliance Krishnapatnam plant, or maybe a plant which is run by a company where they're getting imported coal, I get the coal all the way from Australia, I'm not going to keep a coal stock of 7 days or 10 days. I could end up keeping a coal stock of 3 to 4 months. And because I'm using imported coal, I keep huge stock of raw material. My current ratio could be different compared to the current ratio of this company because their raw material stock is low. So I'm in the same sector, but the current ratios could be different. Leave aside current ratios being different within sectors. So current ratio for an IT company compared to current ratio for a steel company with respect to a cement company could be totally different. Over here, I'm just looking at power generation companies within the same sector also, current ratios could be different. So finally, it was decided that no, this 1.33 is no longer mandatory. Banks will not force and tell companies that no, you should have a current ratio of 1.33. But still, companies generally prefer a ratio which is more than 1 to be on a safer side. Let's go back to this number, which is 0.8. A current ratio of less than 1 indicates that if you have a liability of 1, you have current assets which are less than 1. But still, companies go through it. I mean, there are few companies, but there are still profitable entities across the globe, and they are highly successful, and they have been maintaining a current ratio less than 1 for years and years. How do they do it? If you are a company which has brand name and goodwill in the market, and you can dictate terms to others, then you can operate at a current ratio which is less than 1. For example, let's say you are HUL and I'm your dealer. You will put pressure on the dealer saying that, okay, you will make a payment within, let's say, 15 days or 30 days. So when I get the goods from you, you will tell me that as a dealer, I have to make a payment to you within 30 days. But to produce those goods, you would have taken raw material from some party XYZ. So that party XYZ is your supplier. Because you're a big company, because you're placing orders in crores, and you've got goodwill and brand name in the market, you will dictate terms. You will take the advantage of a strong balance sheet and income statement, and you will tell your supplier, you want to supply goods to me, supply it. I will make a payment in 6 months. Otherwise, there are 10 other suppliers who are standing who are ready to supply goods to me. They're ready to give me a credit period of 6 months, which means these entities, because of the brand name and the goodwill they have, they are able to take advantage and they can operate efficiently even when the current ratios are less than 1. So generally, companies which are successful will be the ones who can operate at a current ratio which is less than 1, but most of the companies generally prefer a current ratio which is more than 1. Any questions on current ratio, which is current asset upon current liability? before we look at quick ratio. And it's a very risky situation where you have a current ratio which is less than 1, because there have been examples of companies which have gone bankrupt because they felt that no, they'll be able to maintain a current ratio of less than 1 and they'll be highly successful. To give you an example, how many of you have heard about this company LML Vespa? Not the Vespa as of today, which is there in India. LML Vespa. Okay. You know about this company LML Vespa? Anyone? Anyone from the batch? LML Freedom bike, that is different. So that was their bike. I'm saying LML and Vespa came together to make scooters in the late 80s and the early 90s. And it was a hit product. They were giving big competition to Bajaj. So LML Vespa, it was a fantastic scooter. So LML and Vespa came together, foreign technology and fantastic quality. So at that time, way back in the 70s and 80s, Bajaj was the leader. They had this product named Chetak. So again, if you go and ask your parents, and if your parents ever bought a scooter, typical answer would be that we had a Chetak scooter. And the issues with them, I mean, if you look at Bajaj, was that Indian technology. So I mean, somewhere or the other, it was little inferior compared to the technology which the other automobile makers had when, let's say, if something is being made in the US or in the Europe. So it was Indian technology which was not at par with that technology. Plus, along with that, you had a lot of waiting time. So, for example, let's say you place an order for a scooter, maybe you'll get a scooter after 6 months, 9 months, 1 year. So, huge waiting time, Indian technology. LML and Vespa came together and they said, okay, we will bridge this gap. They said you'll get foreign technology and you will not have to wait for like 9 months, 1 year. We will give you the delivery in, let's say, the next 3 to 4 months at the same price. So you're getting a better quality product with lower waiting period at the same price. In that case, people slowly and steadily started switching over to LML Vespa. So that was the first dent that was caused in, let's say, the domain of the Bajaj Auto, the Bajaj two-wheeler segment. So slowly and steadily, the sales started going down and LML Vespa's sales started going up. Now, for example, let's say if I make a hypothetical balance sheet of LML Vespa. So let's say this could be the balance sheet of LML Vespa. So they have non-current assets, they have current assets, they have current liabilities, and they have the long-term sources of financing. So let's say this is 1200, this is 800. Now, slowly and steadily, when a lot of people start booking your scooters, what you typically do is you give an advance money. So you do bookings and you give the booking money. And this booking money which is given, so the company will get the cash. So the current asset will go up. But at the same time, the current liabilities also start going up. So let's say hypothetically, let's say this is 1000 and this is 1000. So the company is getting a lot of advance money deposit from the customers to do the booking. So current liabilities are going up. They also have decent amount of cash balance in their company. Now, the company had taken debt to set up their factories. So when the company saw that they have a lot of cash sitting in their balance sheet, they said, let's use this cash to repay off some part of the debt. That's absolutely fine, because if you're sitting on a lot of cash, it doesn't make sense to use that debt. If you have the capacity, repay off the debt. So what they did is, let's say out of this, they used 200 worth of cash, which means they're left with 600 of cash. And let's say they repaid off 200 worth of debt, and now it becomes 800. Now, things went off well for a few years, but then slowly and steadily, what happened in the 90s, people said, no, scooters is fine. What we need is bike. We need motorcycles. We don't need scooters. So that's when Splendor and all these things came. And you look at the late 90s, that time Hero Honda came up with a product which was CBZ. If I'm not wrong, this was the first bike in India, I mean, the Indian manufactured bike which had 5 gears, and it was a hit product. So people said it's better to buy a CBZ bike. Then Pulsar came in, And slowly and steadily, the sales started going down as far as the scooters are concerned. Now, look at this company. This company has current liabilities of 1,000, has less of current assets. So the current ratio is less than 1. I come to your company and I say, no, I want to cancel the booking. Please refund the money. You will deduct some amount and you will pay majority of the amount if the cancellation is done within the specified time period, which is mentioned in the agreement. So let's say these people come, let's say out of these people, 700 people come and they say, okay, we want to cancel the contract. We want the money back. You don't have enough cash to pay the money. Finally, what you do is you go bankrupt. You start selling off your assets to pay off the money. So this was how this company finally went down. So as long as you are in a dominating position, having a current ratio of less than 1 is fine. But the day things change, you start losing out on the market share. People don't like your product or the service that you're rendering. Having a current ratio of less than 1 could be disastrous and you could go down the drain. I mean, you could just go bankrupt. Yep. Okay, then let's look at the next ratio, which is the quick ratio. A quick ratio, how do you calculate it? Quick ratio is nothing but quick assets upon current liabilities. And quick asset is nothing but current asset minus stock minus prepaid expense. So current asset minus stock minus prepaid expense is your quick asset, and you divide it by current liability. So it's a much more stringent number compared to a current ratio. It's more stringent. So current ratio is much more lenient. Quick ratio is saying, no, I will reduce stock, I will reduce prepaid expense, and then you'll get the numerator and I'll divide it by the current liabilities. Now the first question, why do you reduce stock and prepaid expense for calculating a quick ratio? What is the logic? Yeah. Anyone from the batch? Why do you deduct stock and prepaid expense? Very short-term liability fulfillment. Okay. Anything else? Anyone? So for calculating stock will take time to get liquid. Fine. I'm trying to get rid of all those assets which will either take time to get converted into cash or I will not get the cash back. So I take current assets, all my current assets, I'll reduce stock, I'll reduce prepaid expense, and I'll divide it by current liabilities. Why do I reduce stock? I'll have raw material. Raw material will get converted into WIP, then WIP to finished goods. And then finally, I'll sell it to my customer. The customer will take its own sweet time to make the payment, which means from the day I spend money till the time I get back my cash, I could be, let's say it could have a waiting period of 6 to 9 months. So that is not increasing my liquidity. In fact, it's reducing my liquidity. So stock, they said, no, if you're looking at a more stringent measure of liquidity, remove something which will take time to get converted into cash. So remove stock. Why do you reduce prepaid expense? For example, let's say you've paid insurance premium in advance. So let's say you've got an LIC policy and you've paid insurance premium for the next 2 years because you're getting some discount, 10%, 15% discount. Okay, 2 years policy, and I'll pay the premium in advance for the next 2 years. You have a policy period of 15 days or 30 days where you can go ahead and cancel the policy. But let's say after that, somewhere in the 4th month, you feel that no, you need some cash immediately because you have to make a payment to your supplier. Can you go back to LIC and say, no, please give me back my insurance premium? The answer is no. LIC will not entertain it. So prepaid expense, once the money goes out, it's gone. You cannot even get back. Stock will at least get converted to cash, but it will take its own time. So the numerator, basically, when I say current asset minus stock minus prepaid expense, numerator will consist of quick assets. It will consist of those assets which can get converted into cash quickly. So I'll take quick assets in the numerator, I'll divide it by current liabilities, and I'll get the quick ratio. So that's a quick ratio, which is more stringent than the current ratio. So any doubt with the current ratio or the quick ratio before we look at the cash ratio? Okay, then let's look at cash ratio. When I'm looking at cash ratio, I'm being more stringent. So I'm being even much more stringent than a quick ratio. And in the numerator, I'll just take cash and cash equivalents and I'll divide that by the current liabilities. So I'm saying, okay, take only those assets which are extremely liquid, like cash, or they're like cash. So they're cash equivalent, which means you can sell them and get the money quickly. So typically you look at things like a commercial paper, T-bill, your maybe money in the bank, maybe your FDs, fixed deposit, all of that. So that is what will come in the numerator, cash and cash equivalent, and you'll divide it by the current liabilities. So that's a quick cash ratio. So cash ratio is the most stringent. Quick ratio is little lenient. Current ratio is more lenient. So that's like the hierarchy as far as liquidity ratio is concerned. Any doubt with the first three: current ratio, quick ratio, cash ratio? Any doubt till here? Current ratio, quick ratio, cash ratio. Okay. Then let's look at the remaining four and then we'll take a break. Then let's look at debtors collection period, creditors payment period, inventory holding period, and the cash conversion cycle. Let's try and understand this with the help of an example. Let's say I'm a company like Honda. Okay. So I'm into the business of making cars in India. So I'm looking at the car division, not the two-wheeler division. So I'm making cars. And let's say I place an order on 1st of April 21. And my supplier immediately supplies the raw material because there's an ancillary unit, let's say in the next 1 kilometer close to my factory. And the ancillary unit supplies me all those spare parts, the headlights, tires, and everything. And I get the entire raw material. So I place an order on 1st of April. I get the raw material on 1st of April. Now, once you get the raw material on 1st of April, you will not issue it immediately to the factory for further processing because you'll do your quality checks. Once the quality check is done, then you'll store this raw material in the godown. And once you get a requisition from the production manager and the production manager says, okay, send so many carburetors, so many engines, so many tires, etc. It's only then that this raw material will be dispatched from the godown to the factory. Till that time, the raw material is kept in the godown. So let's say that is till 7th of April. So this time frame from 1st April to 7th of April, when the raw material is kept in the godown, is known as raw material holding period. So raw material holding period is the period for which you keep the raw material in the godown before it is issued to the factory for further processing. Any doubt with raw material holding period? Any questions on raw material holding period? Okay, fine. And let's say on 8th morning, the factory manager gives a requisition, please dispatch so many units of X, Y, Z, and the godown manager dispatches all of that. Now, once it is dispatched, I mean, the car is not ready immediately within 1 minute or so. Let's say for ease of or simplicity, let's say it takes you, let's say 3 days for the car to be ready. Now, with the help of technology and everything and automated lines, I mean, the car is ready within, let's say, 6 to 7 hours. And if you have better access to technology, it could be ready, let's say, within 4 to 5 hours. Compare this to, let's say, a Bentley or so. It will take its own sweet time. Rolls Royce, it will take years or months to be made. One Rolls Royce could, I mean, it could take like 8, 9, 10 months to be made because it's handmade. So a lot of things over there are basically done with hand. It's not the technology which will be used over there. So that could take months. But let's say for ease and for understanding purpose, let's say it takes 3 days. So let's say it takes 3 days for me to make one Honda car. So this time frame, when neither do you have an end car, nor do you have the raw material. It's somewhere in the middle. That is known as WIP conversion period. So WIP conversion period is the time which is taken for the raw material to get converted into a finished product. Now, once the car is ready on 10th, you immediately don't dispatch it to your dealers. You'll get a requisition from the dealer. The dealer will say, okay, send me so many white color cars, blue color cars, this model, Honda City, CRV, whatever it is, and accordingly, the cars will be dispatched. Till that time, the cars will be in the go down of the company. So let's say the cars are there in the go down till 15th. So this time from 11th of April till 15th of April, when the finished product is held in the go down, is known as finished goods holding period. So finished goods holding period is the time for which the finished goods are kept in the go down before they're sold to the end customer. On 16th morning, you get a requisition from your dealer. So you dispatch the cars, you generate a bill, you raise the invoice, but the dealer is given a credit period of 15 days to make a payment, which means the dealer will make the payment only on 30th of April, even though the goods are getting dispatched from on 16th of April. The dealer in Delhi or Mumbai or whatever, they'll make a payment only on 30th of April. So this time frame that is given to your customer to make a payment, that is a dealer, is known as debtors collection period. So you place an order for the raw material on 1st of April and you get the money on 30th of April. Now, you place an order on 1st of April doesn't mean that you would have paid the money to your ancillary unit on 1st of April. Again, you would be using the strength of your balance sheet and your income statement, and you would dictate terms. And let's say you tell your ancillary unit, okay, I will make a payment after 12 days. Which means you place an order on 1st, you get the raw material on 1st of April, but you're making a payment on 12th of April. So this time frame is known as creditors payment period. So creditors payment period is a time which you get as a company to make a payment to your supplier. So when is the money going out of your pocket? Money is going out of your pocket on 12th of April. When is the money coming in? Money is coming back on 30th of April. This time gap, when the money is going out and the money is coming in of 18 days, is known as operating cycle time or cash conversion cycle. So money goes out of the pocket on 12th April. It comes back to you on 30th of April. So these 18 days are known as operating cycle time or cash conversion cycle. Any questions on this, anyone? Yeah. Any questions, any doubt with the operating cycle time? Any questions on this? So how do I calculate my operating cycle time or my cash conversion cycle? My operating cycle time or cash conversion cycle is nothing but raw material holding period plus WIP conversion period plus finished goods holding period plus debtors collection period minus creditors payment period, which means I'll take this time frame, which is 30 days. I'll deduct this time frame of 12 days and I'll get 18 days of operating cycle time or cash conversion cycle. And companies would like this time frame to be as small as possible because you don't want the money to go out of your pocket and the money to come back after 6 months or 9 months. I'm giving a break here. I just said I'll finish this and we'll take a break. Any doubt with operating cycle time or cash conversion cycle? So that's your debtors collection period, creditors payment period, inventory holding period, or the cash conversion cycle. In the service sector, typically what you'll have is you'll have just the debtors and the creditors payment period. You'll typically not have the inventory holding period. So you'll not have raw material, WIP, finished goods. So what you'll typically have is debtors and creditors. So let's say you would be availing services from someone, so you will have to make a payment after some days. So that's your creditor's payment period. You are giving service to someone, that person will make a payment to you in few days. That's your debtor's collection. Yep. Okay. So with this, we are done with liquidity ratios. We'll take a break. And then once we resume, we'll start with profitability ratios and move to the solvency ratios. So it's 11:51. Let's resume at 12:05 and then we'll continue. So let's resume at 12:05. Okay, so let's resume. Let's look at the next set of ratios, which is basically nothing but your profitability ratios. So we'll look at profitability ratios. Now, in profitability ratios, there are various ratios that we'll be looking at. We'll be looking at these 5 ratios, which is your gross profit ratio, net profit ratio, return on equity, return on asset, and return on capital employed. So let's look at the first one, which is your gross profit ratio. If I look at a gross profit ratio is nothing but gross profit upon sales into 100. And how do you calculate your gross profit? Gross profit is nothing but sales minus cost of goods sold. So sales minus cost of goods sold will give you the gross profit. Divide that by your sales, you'll get the gross profit ratio. Now, anyone can tell me what does this ratio basically tell you? So let's say if I do the calculation and this number comes to 55%, what does this ratio tell me? I've done the calculation and I get an answer of 55. Operating profit is different. So operating profit is different from a gross profit. Anyone? Gross profit ratio basically tells you what is the percentage of cost that is incurred in the factory for producing your goods. So it basically tells you maybe how efficiently you're running a business, you're using your labor, your material cost, and other costs which are incurred in the production process. So if my gross profit ratio is 55%, which means I'm saying that out of 100 rupees of sale that I have, 45 rupees was my cost of goods sold, and balance 55 is the profit that I've generated after taking into account the cost incurred in the factory for the production of the goods. And companies would like this number to be on a higher side, because after this you have other expenses also which are not related to the factory. For example, your admin expense, your selling and distribution expense. So if you have a higher gross profit ratio, then the chances are that you'll end up with a lower net profit ratio, which is your final profitability number. So companies want this number to be on a higher side. Any doubt with the gross profit ratio? Okay, and let's look at the next one. The next one is nothing but your net profit ratio. So if you look at your net profit ratio is nothing but net profit upon sales into 100. So that's your net profit ratio. Net profit ratio is net profit upon sales into 100. So this is like the bottom line. This is like the final profit which is earned by the company. And this is the profit which belongs to the shareholders. So again, whether it's good or bad on a standalone basis, it may not be that helpful. So what you look at is what has happened within the company over the last few years. So let's say, if you look at the number for the last 3 years, your net profit ratio was 15%, then it became 18%, and then this year it is 22%, which means you're telling me that year on year, your net profit ratio is going up. But at the same time, you'll also compare it with, let's say, your peers. If you compare it with the peers, and the peers have a net profit ratio, let's say an average net profit ratio of, let's say, 29%. So you're still lagging to your peers, but at least your performance has been going up, it's improving. So performance is improving, but more improvement is required because you're still lagging as far as the profitability is concerned compared to your peers. So that's your gross profit ratio and your net profit ratio. Any doubt with gross profit ratio, net profit ratio? Before we look at the remaining 3, which is return on equity, return on asset, and return on capital employed. Any questions on this? Then let's look at return on equity. If I'm looking at, let's say, return on equity, return on equity is the return that the company generates for its equity shareholders. So how do you calculate your return on equity? Return on equity is nothing but profit after tax divided by the shareholders fund into 100. So whatever profit you've generated for your shareholders, that's your profit after tax. You'll take that, you'll divide it by the shareholders fund, which is equity, and multiply that with 100. So let's say my profit after tax is 100, shareholders fund is 400. I get a return on equity of 25%. Now again, whether it's good or bad on a standalone basis, it doesn't tell me. So look at your past performance, look at how you performed in the past, whether this number is increasing, it's going down, or it's fluctuating. Compare yourself with your peers so that you get a fair idea as to where you stand. And you should also be comparing your return on equity with something which is known as cost of equity. Any idea what is cost of equity? Yeah, anyone? What is cost of equity? Anyone from the batch? Expected return, fine. So cost of equity is nothing but the return which is expected by the equity shareholders. So let's say you are an equity shareholder of maybe, let's say, Infosys, and you are expecting a return of, let's say, 18% from the company. So this is a return for you, but it is a cost to the company because the company has to give you this return. So it's a return for the shareholder, but it's a cost to the company. So let's say the shareholders have an expectation of 18%. The company has given a return of 25%. So that's good because you're telling me that the return that you're generating is more than the cost. So it's good because you've created value. So don't only just look at what's your past performance, look at what's happening with your peers and also compare your return on equity with the cost of equity to get some sort of an idea whether it's a good number or a bad number. Any doubt with return on equity? Okay. Then let's look at the next one, which is return on asset. Now, return on asset is basically nothing but it tells you how efficiently you are running your business and what is the profitability that you're generating when you use your assets. So if I look at how do I calculate my return on asset, that's ROA. So my return on asset is nothing but profit after tax divided by total assets into 100. That's my ROA, profit after tax divided by total assets into 100. That's my ROA. So again, it talks about how efficiently you manage your assets, the return that you're generating from them, and do the same thing over here. Look at the past track record, whether it's going up, going down, or it's fluctuating. Compare yourself with your peers so that you get a fair idea whether you are generating more returns on your assets or is it that your peers are generating a better return on the asset. So look at the past and also compare it with the peers. So that's your return on asset. And then finally, the last profitability ratio that we have is return on capital employed. Anyone who can tell me how is return on capital employed different from return on equity? Return on capital employed, how is it different from return on equity? I've got ROCE, which is return on capital employed. And then we already discussed ROE. How is it different? How are these two different? Thanks, Kumar. It says it talks about the return on the total capital, income tax, interest before interest and tax. Capital employed would also include non-current debt. Fine. So if I'm looking at return on capital employed, I'm looking at a broader base. I'm not only looking at the return for the shareholders, I'm also looking at a return for anyone and everyone who's given me long-term funds, be it equity shareholder, be it preference shareholder, be it a lender who's given me a long-term loan, or be it a debenture holder who subscribed to my bonds, which are long-term. So I'm looking at a return for anyone and everyone who's given me long-term funds. So here, how I calculate my return on equity is, I look at EBIT, I divide it by capital employed, and I multiply it with 100. So EBIT is nothing but earnings before interest and tax. So this is earnings before interest and tax. Now over here, why do I take EBIT and not PAT? Because here I was taking profit after tax. So why is it that in ROC I don't take PAT but I take EBIT? Why? We include returns for the shareholders, because see, for ultimately what you do is from EBIT you will reduce interest, which is the return for the lender, for the debenture holder, bond holder, whatever it is. So any debt instrument you'll be giving interest. So you'll get PBT, then you pay tax to the government and you'll get your profit after tax. And from this profit after tax, you'll give your dividends to your shareholders. So when I'm looking at return on equity, I'm fine with this because from PAT, I will give dividends to my shareholders. But when I'm looking at ROCE, I'm looking at a return for anyone and everyone, that's the shareholders and the lenders. So I have to give dividends. I also have to give interest. So I'm looking at a number which is pre-interest, pre-dividend, and therefore that is nothing but your EBIT. So you take your EBIT divided by capital employed, multiply it with 100, you'll get your ROCE. And capital employed is nothing but your shareholders fund, which is your equity, that's share capital plus reserves and surplus, plus your long-term debt. So take your long-term capital plus reserves and surplus, you'll get your capital employed. Again, just like ROE for ROCE, you look at your past performance. So see what's happening within the company, compare yourself with the peers, and here you'll compare your return on capital employed with WACC, which is weighted average cost of capital. Any idea what's weighted average cost of capital? Yep. Anyone? What's WACC? Weighted average cost of capital. What does it mean? Okay. Weighted average cost of capital in simple terms is, let's say you're running a company and you've raised, let's say maybe 100 crores through equity and another 100 crores through long-term debt. So total amount raised is 200 crores. Let's say equity shareholders, when they fund your company, their expectation is 20%. Say they want a return of 20%. So for the company, it's a cost. Similarly, let's say the lenders have an expectation of 10%. So first what you do is you calculate the weights. So this is already my cost. So it's a return for the equity shareholder or the lender, but it's a cost to the company. And I'll calculate weight. What is weight? Weight is nothing but proportion of each source in the total capital employed. So I look at, okay, equity is 100 out of 200, which means that is 50% weight. Similarly, debt is 100 out of 200. So again, that's a weightage of 50%. Put together, the total of the weights should be 100%. So after this, you will calculate your WACC. So how do you calculate your WACC? As the name suggests, it's weighted average cost of capital. So you'll multiply the weight with the cost. So 50%, 20%, that's 10%. And then 50% into 10%, that's 5%. Add it up. What you get is 15%. So that's nothing but your weighted average cost of capital. So weighted average cost of capital is the minimum return that is expected by equity shareholders and lenders put together. So equity shareholders and lenders put together are expecting a return of 15%. Individually, lender is expecting a return of 10%, but the equity shareholder is expecting a return of 20%. Put together, their expectation is 15%. So this is the return that is expected by them. Compare this with the ROCE. So let's say ROCE is 18%. So you're telling me that the company has generated a return which is more than the cost. It is good for the company. Vice versa, if the return is less, so let's say the return is 12%, but the cost is 15%, doesn't make sense to raise money from equity and debt. So that's your weighted average cost of capital. Any doubt with ROCE? Any doubt with profitability ratios? Anyone? Before we start looking at, let's say, the solvency ratios. Any questions on this? Okay. Then let's look at solvency ratios. So as the name suggests, solvency ratios or leverage ratios, these are ratios which talk about long-term repayment capacity. It talks about how the company has been funded. It talks about the capital structure of the company. Now, when you're looking at, let's say, your leverage ratios or solvency ratios, the two most important ratios are your debt to equity ratio, and there is one more which is known as DSCR, which is debt service coverage ratio. So these are the two most important ratios, debt equity ratio and DSCR, which is a debt service coverage ratio. Interest coverage ratio, I would say, is a subset of DSCR. So interest coverage ratio is on similar lines, but it's a smaller concept. Debt service coverage ratio is a broader concept. So the two most important ratios are debt equity and DSCR. Let's look at debt equity and DSCR. Let's look at debt equity ratio. Now, when I want to calculate my debt equity ratio, how will I calculate my debt equity ratio? For calculating your debt equity ratio, you'll take your long-term debt and you'll divide it by the shareholders' funds. So let's say my long-term debt is 500 crores, shareholders' fund is 1000 crores. I'll get a debt equity ratio of 0.5, which means for every 1 rupee of long-term liability that I have, my shareholders' fund is 2 rupees, or vice versa. If I have 1 rupee of shareholders' fund, my long-term debt is only half, which is 0.5. And the lower the ratio, the lower is the risk in the company. Higher the ratio, more is the risk in the company. Why do you think lower ratio means low risk and high ratio means high risk? As far as debt equity ratio is concerned. So why is it that a lower ratio means low risk and high ratio means high risk? A lower ratio means low debt, and a low debt would mean that the chances that the company would go bankrupt are low. The chance that the company would default are low. So even the risk for the banker who's funding you, who's giving you the money, goes down. Because let's say on one side, for example, let's say I've got Adani Group, which has huge debt. And on the other side, I've got a company like TCS, which has almost zero debt. So the chances that Adani Group could go bankrupt are more. The probability is more compared to, let's say, TCS, which has less debt. So lower the ratio, lower is the risk, higher the ratio, higher is the risk. So that's how you calculate your debt equity ratio. Debt equity ratio is long-term debt upon shareholders' fund. Then let's look at the next ratio, which is important one, which is your DSCR, which is your debt service coverage ratio. Let's look at debt service coverage ratio. Debt service coverage ratio. Now, how do you calculate your debt service coverage ratio? Debt service coverage ratio is nothing but EBITDA minus tax upon interest plus the principal. It's EBITDA minus tax upon interest plus the principal. So EBITDA is earnings before interest, tax, depreciation, and amortization. From this, you'll reduce the tax and then you'll divide it by the interest and the principal component for the year. First thing, why do I take EBITDA minus tax? Why do I take EBITDA? Why not, let's say, profit after tax or something like this? Why is it earnings before interest, tax, depreciation, amortization? Yep. Anyone? Why EBITDA? I take EBITDA because depreciation and amortization is a non-cash expense. So they will reduce the profit, but they have no impact on cash. For example, let's say you have an asset. You've charged a depreciation of 10 crores on that asset. That will increase your expense and reduce your profit, but it does not impact your cash balance. It's a non-cash expense. So I need a number which is before non-cash expense so that I can find out whether I'll be in a position to pay off my debt or not. It's like going to a bank and applying for a home loan. So when you go to a bank and apply for a home loan, what is it that the banker tries to assess? What is it that the banker is trying to look at when you go and apply for a home loan? So let's say you applied for a home loan of 1.5 crore. So when you put in your file and you have your documents over there, what is the banker trying to assess? And what documents will the banker basically look at? Yeah, anyone? You've gone and applied for a home loan. They'll of course look at the CIBIL score, fine. Whether he'll be able to pay it or not. Okay. What else? What all documents are they basically interested in? A CIBIL score, definitely, fine. What else? If you're a salaried person, they're basically interested in your pay slips. So they'll ask you to submit your pay slips. They'll tell you to submit your income tax returns for the last 3-4 years. If you're a businessman, they'll tell you to submit your balance sheet, income statement, and the cash flow statement, because they're trying to look at how much cash you're generating on a regular basis. So typically, if you're a salaried person, in your pay slip, you'll have something like this. You'll have your gross pay, and then you'll have your net pay. When you apply for a home loan or a car loan or whatever it is, a banker, is he looking at your gross pay or your net pay, and why? Does he focus on the gross pay, net pay? Why? Okay, I've got an answer, net pay. Why do you think he's looking at net pay and not the gross pay? net pay is nothing but your takeaway home salary after taxes, PF, pension, whatever it is, after all deductions that you have. Because companies, they're very creative in coming up with CTC. So they'll come with CTC where they'll say insurance premium paid by us is a part of CTC. You are occupying this place, the rent for that is a part of your CTC. They're very creative in doing all of this. Now, as a banker, I'm not concerned with that. As a banker, I'm saying, okay, how much amount is getting credited into your bank on a monthly basis? What's your takeaway home salary? So net pay is basically like your takeaway home salary. So let's say your takeaway home salary is 3 lakh a month. So after taxes and everything, after all allowances, deductions, everything, 3 lakh a month. So the banker will say, okay, numerator, which is your takeaway home salary. So that's like a takeaway home salary for a company, because that becomes like EBITDA minus tax. So on a yearly basis, it becomes how much? 3 lakh into 12, which is 36 lakh. And they'll say, okay, how much is the interest and the principal that you're supposed to pay on a yearly basis? So let's say your interest and the principal put together, which is typically your EMIs, which is equated monthly installment into 12, because EMI is on a monthly basis. I multiply it with 12, I'll get the total interest and the principal that I'll pay to the bank on an annualized basis. So let's say my EMI is 1 lakh a month, which means for the entire year, it will become 12 lakh. So interest and the principal put together becomes 12. So I'll say, okay, takeaway home salary is 36 lakh per annum. Total interest and principal that I have to give to the banker is 12 lakh. So my DSCR is 3. Generally, when companies sanction a loan to a corporate and they're looking at DSCR, they prefer a DSCR of at least 1.7, 1.8. So let's say as a company, your numerator over here is 40. They would expect that you have a denominator of maybe, let's say, 21, 22, nothing, I mean, nothing more. I mean, it should be at least 1.8. So maybe let's say even 25 is fine. So you get a DSCR of at least 1.7, 1.8. Now the question is, why 1.7, 1.8? Why not, let's say, 1.1 or 1.2? So let's say if my numerator is 40, what is wrong if my denominator is 38? Because I'm saying that I'm generating more than what is required to be paid to you. So what is wrong? So what is the problem in having a DSCR of just 1.1, 1.2? Why do banks generally look at and say that, okay, if the DSCR is less than 1.7, 1.8, we are not interested in sanctioning the loan? If you generate 40 on an yearly basis, which means, let's say this is your takeaway home salary, and out of 40, if 38 will go in repayment of loan, it becomes difficult for you to maintain your standard of living, for your grocery bills, for your kids' education, for your traveling and everything, that you'll have only 2 lakhs. So the banks also know that you need to maintain your standard of living. You have your regular expenses, you have to take care of those expenses also. So they set aside 80% and they say, okay, balance can be used for the company to pay off the loan. So that is why they say, okay, you should have a DSCR of at least 1.7, 1.8. Anything less than that, the bankers are a little hesitant. Unless and until, let's say, you give more collateral or something happens under the table, then it's a different ballgame. But otherwise, generally, as a thumb rule, they would prefer something which is at least 1.7 to 1.8. So let's say you've taken a loan of 100 crores and it is to be repaid in 5 years, and you pay a principal of 20 crores each year. So you've taken a loan of 100 crores, it is to be repaid in 5 years, and the principal is to be repaid in equal installments of 20 crores. And let's say the interest is 10%. Can you tell me, on an yearly basis, that's year 1, 2, 3, 4, 5, how much would you be paying to the bank? You've taken a loan of 100 crores. You're supposed to repay it in 5 years. And the bank has said that, okay, repay the principal in equal installments of 20 crores each year. And then they're also saying that interest rate is 10%. So how much are you paying yearly to the bank for in year 1, year 2, year 3? How much? First year, you'll pay 20 crores, which is the principal component plus the 10 crore. Okay. Next year, again, you'll pay 20, 20, 20, 20. So this is constant. What will keep changing is the interest component. Because next year, out of 100, you already paid 20, which means you're left with 80. On that 80, the banker will charge you an interest of 10%, which means you'll pay 8, then you'll pay 6, then you'll pay 4, then you'll pay 2, which means you'll pay 30, 28, 26, 24, 22. So let's say if you are supposed to make a payment of 30 in a year, so that's your denominator. The banker will expect the numerator to be at least 54, 55 because he wants a DSCR of at least 1.7, 1.8. So this is your DSCR. So DSCR basically looks at the cash profit, whether you can repay off the loan on time or not. And they will keep that buffer of 70, 80% because that money will be used by the entity, by the businessman for their day-to-day operations, for their capital expenditure, because companies, they need money for capital expenditure. They have to buy assets. They need money for their day-to-day operations. Then they also need money to give, let's say, returns to their investors. So I have to give returns to my shareholders. Plus, at the same time, I also need to keep aside some amount of money for contingency. So assuming 20% for each, so that makes it 80%. So that's how you get a ratio of 1.8. So keep aside some money for capex, for your day-to-day operations, for giving returns to your investors, and for meeting contingency. Put together 80%. Balance can be used to repay off the loan. So any doubt with this 1.8? Okay. Now, typically, how would a banker use debt equity and DSCR parallelly to take a decision whether the loan is to be sanctioned or not? So typically what they'll do is they'll open an Excel sheet. So on Excel sheet on one side, they'll have something which is like a DSCR. And on the other side, what they typically have is a debt equity ratio. So let's say they have 3 proposals in front of them. So this is proposal 1, proposal 2, proposal 3. So they'll have debt equity ratios and the DSCR. So they'll say, okay, let's start with a debt equity ratio of, let's say, 1:1. So if the debt equity ratio is 1:1, then they'll calculate the DSCR for project 1. Similarly, they'll calculate DSCR for project 2, and they'll calculate the DSCR for project 3. Let's say they come up with some numbers, and the numbers are, let's say, hypothetically 3. Let's say it is 2.5, and let's say it is 2. So it meets the criteria because they want a DSCR of at least 1.7, 1.8. So they don't have an issue if the company has a debt equity ratio of 1:1. Now they'll increase it slowly. They'll say, okay, what if the debt equity ratio increases and it becomes, let's say, 1.5:1? Let's say the debt equity ratio becomes 1.5:1. Now, if the debt equity ratio increases, what will happen to your DSCR? Will it remain the same? Will it go up? Will it go down? And why? Yeah, anyone? If your debt equity ratio increases, your DSCR will remain the same. Will it go up? Will it go down? And why? Okay, Ankit is saying it will go down. Okay, then why do you think it will go down, Ankit? Kumar is also saying it will go down. Why? Why do you think it will go down? Now, if you look at your DSCR, how do you calculate your DSCR? It's nothing but EBITDA minus tax upon the interest and the principal component. Now, if your debt equity ratio is increasing, which means you've taken more debt. If you've taken more debt, all other things being constant, what will happen? Your interest and the principal component that you have to pay to the banker will go up. So if this goes up, all of the things being constant, your DSCR will go down. So let's say with the increase in the debt equity ratio, this becomes, let's say, 2.5. Let's say the second one becomes 2, and this becomes 1.8, which means I'm saying project 3 hits the bucket with a debt equity of 1.5:1. So that's the maximum debt equity ratio that project 3 can have. Beyond that, bankers will be hesitant and they will not be ready to fund project 3. Then they'll take it further. They'll make it, let's say, 2:1. So this will again go down. Let's say this becomes 1.75. This is already out of picture, which means project 2 will hit the bucket when the debt equity ratio is 2:1. Then maybe they'll increase it. Let's say this becomes 3:1. And then this becomes 1.81. This is already out of picture. This is already out of picture. So project 1 hits the bucket with a debt equity ratio of 3:1. So this is how typically banks will try and calculate what is the overall debt equity ratio that the companies can have, which is within the DSCR that the bank wants. So as long as your debt equity ratio is within that limit, the bankers generally will not have an issue. But if you try and cross that limit, then the bankers will either start charging a high interest rate, or they'll ask you for more collaterals and guarantees, or they'll start rejecting the loans and they'll say, no, we don't want to sanction the loan. Any questions till here? Anyone? Any questions till here? Okay, then let's move further. Let's say I'm a company like Jindal Steels, JSW. I'm setting up a greenfield project. I'm going for a greenfield project. First of all, anyone who has no idea what's a greenfield project? Anyone know who has an idea and can tell me what's a greenfield project? So you can either have a greenfield project or maybe you can have a brownfield project. Greenfield project is when you start from the scratch. It's a new project. You go to the new place and start from the scratch. So let's say you clear the grass and you start building your project. That's a greenfield project. So let's say Jindals have started to go to another location and they want to set up their steel plant over there and they want to start from the scratch. And they've approached a bank for a loan and they're saying that, okay, we want a loan of, let's say, 10,000 crores. But if they take this loan of 10,000 crores, what will happen is their debt equity ratios will change. The debt equity ratio will become, let's say, 2.5:1. And if they go ahead with this 10,000 crore worth of loan, the DSCR will become, let's say, 1.42. So they want a loan of 10,000 crores, which means the debt equity ratio will become 2:1, which will lead to a DSCR of 1.42, which is far lower than 1.7, 1.8. They have put the proposal, or they're planning to put the proposal to the bank, but they are a little hesitant because they feel that the banker may reject their proposal. So they approach you. You are a project financer, you are a consultant. What advice can you give them so that it's a win-win situation for everyone? It's a win-win situation for the company. It's a win-win situation for the bank. The bank sanctions the loan. I mean, they don't bear too much of a risk. At the same time, the company gets a 10,000 crore loan and they also have a debt equity ratio of 2:1. What advice can you give as a consultant to the company? Yeah. So that the loan is sanctioned. How can you help them? Yeah. Anyone from the batch? How would you help them? What advice can you give them? Yeah. think you're the project financer. I've approached you. I'm saying that I want a 10,000 crore loan, but this will lead to a DSCR of which is 1.4. Banker may not be ready because he wants a DSCR of 1.7, 1.8. But I still want the 10,000 crore loan and I'm not budging. I don't want a debt equity of less than 2.5. I'm not ready with a debt of, let's say, 5,000 or 6,000 crores. I want 10,000 crores. What can you do as a consultant so that the loan gets sanctioned? Equity, I mean, I can't issue equity. That will take its own sweet time because I'll have to do the road shows, appoint an investment banker, lead manager. That will take time. I'm not waiting for the next 1-2 years. I can't do that. Deferred taxes, no, nothing to to repay some of the loans. So I'll repay some of the loans and I'll take new loan. Then what is the point in doing and taking a loan? I'll not repay some of the loans and take a fresh loan of 10,000. Because then the bank will question me, if you already have cash to repay off the old loan, then why do you want 10,000 crores? Use that cash and bring down this debt. Take, instead of 10,000 crores, take only 7,000 or 8,000 crores. But I'm saying, no, I want to take 10,000 crores only. Yeah. Anyone? I will ask the company, what is the tenure of the loan that you basically take? They'll say, okay, we are planning to take this loan for 12 years. And I'll say, okay, is there a problem if the loan instead of 12 years is taken for 15 years? So if the loan is taken for 15 years instead of 12 years, what will happen? All of the things being constant, if you increase the tenure of the loan, what will happen? Tell me. All of the things being constant, you'll get a higher interest. Okay, fine, higher interest. Fine, the banker will charge you a little higher interest. But ultimately, what will happen is your EMIs will go down, which means the denominator will go down, which is your interest and the principal. Because the same amount of loan with a little bit of extra interest rate, because the banker feels that he's sanctioning a loan instead of 12 years for 15 years, the banker might charge a little bit of higher interest rate. But ultimately, what will happen is your denominator will go down. And if the denominator goes down, your DSCR will start going up. So I'll say, okay, instead of a 12-year loan, if you take and stretch the tenure to a 15-year loan, this DSCR from 1.42 becomes, let's say, 1.71. So it's a win-win situation. So I'll just say, okay, come with your proposal now, make it a 15-year loan, tell the banker that you still want a 10,000 crore loan, but it's not for 12 years, it's a 15-year loan. Your DSCR is 1.71. All your documents are in place. The banker should have no problem in sanctioning the loan. Any doubt with this, anyone? Yeah. Any questions on this? Okay. Then let's look at the next one, which is interest coverage ratio. So like I said, interest coverage ratio is a subset of your debt service coverage ratio. So in debt service coverage ratio, what you typically do is you look at whether you can pay the interest and the principal on time or not. So denominator is interest and the principal, and numerator is EBITDA minus tax. But in case of interest coverage ratio, and I'm looking at, let's say, an interest coverage ratio, then my numerator and the denominator will change a little bit. My numerator will change. My numerator will become EBIT, and denominator will be only interest. So in interest coverage ratio, I'm just looking at the interest repayment capacity. In DSCR, I'm looking at the total repayment capacity. So in DSCR, I'm seeing whether you can pay interest and principal. In interest coverage ratio, I'm just looking at the interest repayment capacity. So it's a much more narrower concept compared to DSCR, which is a broader concept. Any doubt with interest coverage ratio or the debt service coverage ratio? Okay. Now, again, from an exam point of view, please go ahead with EBIT. There's no problem. But then in real life, technically, it should not be EBIT. This should also be the, numerator should be the same, which is EBITDA minus tax. Because if you look at EBIT is just an accounting number. So I'm not concerned with an accounting number. I want cash profits in the numerator. So technically, it should be EBITDA minus tax and not EBIT. But then again, if I'm not wrong, in your notes and your async content, it's given as EBIT upon interest. So stick to that as far as exams are concerned. In real life, technically, you should be taking EBITDA minus tax in the numerator. Denominator will be the same, which is interest. Let's say this loan is taken in a country like Cayman Islands or maybe Mauritius. Then do you think there'll be some difference in the formula that you'll be using? And I'm calculating my DSCR or interest coverage ratio. Will there be any difference or it'll still be the same? If the loan is taken in Cayman Islands or maybe something like Mauritius or maybe in Middle East. All these are tax havens. So especially if you look at Cayman Islands and Mauritius, they are tax havens. So taxes will not be there. You look at Middle East, again, off late they've started, they've come up with the tax norms, but initially for so many decades, the taxes were not there. Plus, along with that, in the Middle East, interest is not taken. So it's there in their religion, if I'm not wrong, which says that interest should not be collected. So what they typically do is at the time of sanctioning of the loan, they charge an upfront fees. So you'll not pay interest, but you pay a commission or a brokerage initially, and that's how the loan gets sanctioned. So accordingly, what will happen is when you take a loan from Cayman Islands or Mauritius, this tax part will not be there. You'll just have EBITDA upon interest plus principal. Similarly, if you take it from the Middle East, this interest may not be there because what you just do is repay the principal. Interest is not calculated separately. What you do is initially only at the time of sanctioning of the loan, you would have paid brokerage or the commission cost. Then we could move to the last one. Let's say, which is your debt to asset ratio. So let's look at debt to asset ratio. The name itself will suggest and tell you what will be the formula. What do you think will be the formula for debt to asset ratio? Debt to asset ratio. Debt to asset ratio, as the name suggests, it's nothing but your long-term debt and you'll divide it by your total asset. So that's long-term debt to total asset. And let's say you calculate this ratio and let's say your long-term debt is 100 crores, total debt is 400 crores, you get a number of 0.25. What does this ratio tell you? So if your long-term debt to total asset is 0.25, what does it mean? Assets under stress? No, it's not assets under stress. I've just taken 100 crores of long-term debt and they're backed by assets worth 400. I've got total assets worth 400. No, so it's not assets under stress. Higher capacity to pay. Fine, I'll just tell you. When you look at a long-term debt to the total asset ratio, it basically tells you what is the proportion of asset that is getting funded through your debt. Again, make a balance sheet. Things will be much more clear. You have your total assets. Total assets are 400. Total of the liabilities should also be 400. I'm saying I've got long-term debt of, let's say, 100. And let's assume there's no short-term debt. So short-term debt is 0, which means balance 300 is the money that is being pumped in by the shareholders. So I'm saying 25% of my assets are getting funded through debt. Balance 75% is getting funded through shareholders fund. So lower the ratio, lower is the risk. Lower the ratio, lower is the risk. And if this ratio is high, then it's reverse. Higher the ratio, higher is the risk. Because then in that case, you're telling me that a majority of your fixed assets are getting funded through debt. So let's take, if I change the numbers and let's say I tell you that this is, let's say, 300, which means you're telling me that 75% of your assets are getting funded through debt and only 25% of your assets are getting funded through shareholders funds. And again, link this to your debt equity ratio. So again, indirectly, you're telling me that this company has more of debt compared to the first company. First company had less of debt. So first company had less debt. So of course, the risk is low. Second company has more debt. Therefore, this ratio is high and it leads to higher risk. So again, I mean, these are typically like a corollary ratios. You already know your debt equity ratio, then you can play around and dance around and create as many ratios as you want. Like I said, to the two most important ratios are basically your debt equity ratio and your DSCR. This last thing, and then we can end it. If I'm looking at, let's say, a debt equity ratio for a tech company, IT company, a tech company, what do you think would be the debt equity ratio? Will it be high? Will it be low? And why? Okay, Ankit has said it will be low. Why do you think it will be low, Ankit? Okay. The various reasons because of which the debt equity ratio for these companies are low. I mean, look at companies like Infosys, TCS, Wipro. All these companies, the debt equity ratio will be like 0.0001, 0.0005, something of that sort. So the debt equity ratios are extremely low. And there are various reasons. First, when you go and take a loan from a bank, typically the banker will ask you for some sort of a collateral or a guarantee. Now, understand most of the IT companies, other than the big ones. So, if you exclude the big 5 or 10, like Infosys, TCS, Wipro, Tech Mahindra, HCL, so on and so forth. Now you have L&T and the Mindtree. Exclude all these. Most of the IT companies will typically operate through leased premises, which means they don't even have their own buildings and offices. They have taken that on rent and they're operating through those premises. Now, if you go and take a loan from a banker of, let's say, 1,000 crores, and you go and tell them, I'll give you my laptops, desktops, everything as a collateral, because, I mean, of course, you can't give your employees as a collateral because the employee is not recorded as an asset in your book. The next biggest asset will be the laptops, desktops, furniture, fixtures that you have in your office. And you go and give that as a collateral, the banker will not be ready to fund you. Because typically, banker is looking out for an asset which is immovable, where the value will not depreciate a lot. Because if you look at laptops keep depreciating like 40, 50, 60% year on year. So you buy a laptop worth 50,000 today, next year you go and sell it off in the market, you'll not get more than 25, 30,000. Go down 2 years down the line, nobody will be ready to pay you more than 15,000 for that laptop. Now, I have given a loan on the basis of that laptop, and the value in the next 2 years becomes like 20%. You default, what will I do? I'll collect the laptops and I'll start selling it off in the market. That doesn't make sense. So again, that's an inherent problem because of which these tech companies, they will not get the loans. Even if they want it, they'll not get the loans. Second, these tech companies are sitting on huge cash balance. So you look at all these IT companies like Infosys, Google, TCS, Wipro, they're sitting on a huge cash and bank balance and marketable securities. So they don't have to go to a bank and they don't need debt as such, because you typically go and take debt when, let's say, you are running short on cash and you need some amount of loan. You go and take that. I am already having too much of cash, I don't need that debt. Second, I'm into the business of making softwares and products where the technology will keep changing frequently. So today I'm using, let's say, an X software which was made using Y platform, and I go and tell the bank, give me a loan of 1,000 crores. 2 years down the line, nobody wants to use the software because an upgraded software has come and you are still lagging behind. You don't have that software, you don't have that platform, you've not made the software, your competitor has made the software. So now nobody wants to use your software. And I've given you a 5-year loan and your sales start dwindling, your sales start going down. How will you repay off the loan? So there are various reasons why you look at tech companies. These tech companies will have less of debt and they'll majorly be funded through equity. So any doubt with what we've done today? So today's session, we looked at liquidity ratios, then we looked at the solvency ratios, and we also looked at profitability ratios. Any questions on this? Otherwise we can end it. Yeah, any questions? Otherwise we'll call it a day. Okay, bye, take care. Yep, thanks Yunus, thanks Vibor. Yep,